Welcome back to our channel. If you're new, be sure to hit the subscribe button and ring the bell icon so you never miss our latest videos on personal finance and investing. Today, we're exploring how you can start investing even on a tight budget. That's right, you don't need a lot of money to begin building your wealth. Let's dive in. Before you start investing, it's crucial to understand your current financial situation. This means knowing how much you earn, how much you spend, and how much you can save each month. Start by creating a budget. List all your income sources and all your monthly expenses. This will give you a clear picture of your finances and help you identify areas where you can cut costs and save more. Remember, the goal is to find a balance that allows you to save and invest while still covering your essential expenses and enjoying life. Once you have a clear understanding of your finances, the next step is to set your financial goals. These goals will guide your investment decisions and keep you motivated. Start by setting both short-term and long-term goals. Short-term goals could be things like saving for a vacation or building an emergency fund. Long-term goals might include buying a house, funding your retirement, or saving for your children's education. Having clear goals will help you stay focused and make smarter investment choices. Before you start investing, it's important to build an emergency fund. This fund will act as a financial safety net in case of unexpected expenses like medical bills or car repairs. Aim to save at least 3 to 6 months' worth of living expenses in your emergency fund. This money should be kept in a high-yield savings account, where it can earn some interest but still be easily accessible when needed. Having an emergency fund ensures that you won't have to sell your investments at a loss if you suddenly need cash. Now that you've got your budget and emergency fund in place, it's time to start investing. The good news is, you don't need a lot of money to get started. Thanks to technology, there are now many platforms that allow you to invest with small amounts of money. Apps like Robinhood, Stash, and Acorns let you start investing with as little as $5. These platforms offer fractional shares, which means you can buy a portion of a stock rather than having to buy a whole share. This makes it easier to diversify your investments even with limited funds. One of the best ways to invest consistently, even on a budget, is to automate your investments. This takes the guesswork and emotion out of investing and ensures that you're steadily building your portfolio. Set up automatic transfers from your checking account to your investment account. This can be done weekly, bi-weekly, or monthly, depending on your preference. By automating your investments, you'll be investing regularly without having to think about it, which is a key to long-term success. Understanding the power of compound interest, one of the most powerful tools in investing is compound interest. This is where your investment earnings start to generate their own earnings, creating a snowball effect over time. The earlier you start investing, the more time your money has to grow through compound interest. Even small investments can grow significantly if given enough time. This is why it's so important to start investing as soon as you can, even if you're only able to invest a small amount. Diversification is another key principle of investing. This means spreading your investments across different asset classes to reduce risk. A diversified portfolio might include stocks, bonds, real estate, and even commodities like gold. By not putting all your eggs in one basket, you can protect your portfolio from the volatility of any single investment. Many investment platforms offer diversified portfolios that you can invest in with a single click, making it easy to get started. Another great strategy for small investors is to invest in low-cost index funds. Index funds track a specific market index, like the S&P 500, and they offer a way to invest in a broad range of companies with a single purchase. Because index funds are passively managed, they usually have lower fees compared to actively managed mutual funds. This means more of your money is working for you rather than going toward management fees. Over time, these lower fees can add up to significant savings and higher returns for your investments. If you're investing for the long term, consider utilizing retirement accounts like a 401k or an individual retirement account, IRA. These accounts offer tax advantages that can help your money grow faster. Contributions to a traditional IRA or 401k are typically tax deductible, which means you can reduce your taxable income now and pay taxes later when you withdraw the money in retirement. Roth IRAs, on the other hand, allow for tax-free withdrawals in retirement since contributions are made with after-tax dollars. Take advantage of any employer match offered in a 401k plan, as this is essentially free money that can help boost your retirement savings. Dollar cost averaging is a strategy that involves regularly investing a fixed amount of money regardless of the market conditions. This approach can help reduce the impact of volatility on your investments. By investing a fixed amount at regular intervals, you'll buy more shares when prices are low and fewer shares when prices are high, which can lower your average cost per share over time. Dollar cost averaging takes the guesswork out of timing the market and can be a great strategy for small investors looking to invest consistently. Leveraging micro-investing apps. These are designed specifically for small investors. These apps make it easy to invest spare change from everyday purchases into a diversified portfolio. Apps like Acorns round up your purchases to the nearest dollar and invest the difference. This allows you to invest small amounts of money regularly without even noticing. Micro-investing is a simple and effective way to start investing with limited funds and can help you build the habit of investing regularly. Dividend stocks are another option for small investors looking to generate income. These are shares of companies that regularly pay out a portion of their earnings to shareholders in the form of dividends. Investing in dividend stocks can provide a steady income stream and the potential for capital appreciation. Reinvesting dividends can also enhance your returns over time through the power of compounding. Look for companies with a history of paying consistent and growing dividends, as these can be a sign of financial stability and strong performance. Peer-to-peer, P2P, lending platforms allow you to lend money directly to individuals or small businesses in exchange for interest payments. This can be a way to earn higher returns compared to traditional savings accounts. P2P lending platforms like Lending Club and Prosper allow you to start lending with small amounts of money and diversify your investments across multiple borrowers to reduce risk. While P2P lending carries some risk of default, it can be a rewarding addition to your investment portfolio if done carefully. Real estate crowdfunding platforms give small investors the opportunity to invest in real estate projects with minimal capital. These platforms pool funds from multiple investors to finance real estate developments. Sites like Fundrise and Realty Mogul allow you to invest in residential, commercial, and industrial properties, providing diversification and the potential for attractive returns. Crowdfunding real estate can provide exposure to the real estate market without the need for significant upfront capital or the responsibilities of property management. Robo-advisors are automated investment platforms that use algorithms to create and manage a diversified portfolio based on your risk tolerance and financial goals. Robo-advisors like Betterment, Wealthfront, and M1 Finance offer low-cost investment management services, making them accessible for small investors. These platforms handle everything from asset allocation to rebalancing, allowing you to invest efficiently and effectively with minimal effort. Exchange-traded funds, ETFs, are another great option for small investors. ETFs are similar to mutual funds but trade like stocks on an exchange. ETFs offer diversification and low fees, making them an attractive choice for budget-conscious investors. They can cover a wide range of asset classes, sectors, and geographies. By investing in ETFs, you can build a diversified portfolio with just a few investments, even if you have limited funds. It's important to regularly track your progress to ensure you're on track to meet your financial goals. This involves reviewing your investments, assessing your performance, and making adjustments as needed. Use tools and apps that provide a clear overview of your portfolio, including returns, fees, and asset allocation. This will help you stay informed and make better investment decisions. Regularly tracking your progress ensures that you're staying on course and allows you to make informed adjustments as your financial situation and goals evolve. Investing is a journey, and it's important to stay educated and informed along the way. The financial markets are constantly evolving, and staying up to date can help you make better investment decisions. Read books, follow financial news, take online courses, and join investment communities to continuously improve your knowledge and skills. By staying informed, you'll be better equipped to navigate the markets and seize opportunities as they arise. So, what can we take away from today's video? Here are some key tips for investing on a budget. Understand your financial situation. Create a budget and identify areas to save. Set financial goals. Establish short-term and long-term investment goals. Build an emergency fund. Save 3 to 6 months of living expenses. Start small. Use apps and platforms that allow for small investments. Automate your investments. Set up automatic transfers to invest consistently. Leverage compound interest. Start early to benefit from the power of compounding. Diversify your portfolio. Spread your investments across different asset classes. Consider low-cost index funds. Invest in broad market indices with low fees. Utilize retirement accounts. Take advantage of tax benefits. Practice dollar cost averaging. Invest regularly to reduce the impact of market volatility. Explore micro-investing apps. Invest spare change and small amounts. Look into dividend stocks. Generate income through dividends. Try peer-to-peer lending. Earn interest by lending money directly. Crowdfund real estate. Invest in real estate with minimal capital. Use robo-advisors. Automate investment management. Invest in ETFs. Build a diversified portfolio with low-cost ETFs. Track your progress. Regularly review and adjust your portfolio. Stay educated and informed. Continuously improve your knowledge and skills. Investing on a budget is not only possible but also incredibly rewarding. With the right strategies and a disciplined approach, you can start building your wealth today. Remember, the key is to start early, stay consistent, and keep learning. And that wraps up our video on investing on a budget. We hope you found these tips helpful and inspiring. Don't forget to like, share, and subscribe for more content on personal finance and investing. Until next time, happy investing.